is the Ghetto Spread, or as professionals would refer to the strategy, legging into long put or call debit spreads? What's up guys, my name is Nick and welcome to my channel. In this video then, I'll be breaking down this potentially very powerful strategy. I'll explain the risks and rewards of the trade and look at some stock selection and entry criteria that can help nudge the odds of success in your favour. Let's get straight into the video. But before we do, if you enjoy the content, do me a huge favour, smash the like button and subscribe to the channel. It costs you nothing of course, but really helps me push my content to other YouTube users and grow the channel. Thank you, it's very, very much appreciated. With that said then, let's get right into it and I'll see you guys on the other side. Cheers. An option spread is simply a position in which there are at least two option positions, one of which is long and the other is short. So a typical call debit spread then would involve buying a call option and importantly at the same time selling a higher strike, cheaper call. If you are unfamiliar with the basic concepts of debit spreads, you should probably check out a video I've put together explaining that strategy first, and I'll include a link somewhere up here. When we refer to legging into a spread, what we're talking about is buying or selling one of the options prior to the other. In the case of a call debit spread, for example, there is some sort of time lag between the purchase of the first call option and the sale of the second higher strike call. Now, why would you want to do this? Well, we are looking for a movement in the underlying stock following the initial call option purchase, which allows us to then sell the second call at a much better, higher price. Let's take a look at an example. So, if we look at this option payoff diagram for ABC stock, on the vertical y-axis we can see profit and loss. As you move higher up the axis, so profits increase. The point at which the horizontal x-axis intercepts this y-axis is the position break-even. On the horizontal x-axis is the stock price and the option strike prices. As we move from left to right, so the price of the stock becomes more expensive and the option strikes higher. Okay, so on day one of the trade, with ABC stock trading at $100, we are bullish and looking for the stock price to move higher. We're going to buy one 100 strike call option, and the premium for this option, or the amount we have to pay, is $5. This call option is at the money. The same principles of this trade can be applied, of course, when we are bearish. We would simply use a put rather than a call, but for this example, I'll be using call options. So, take a look at the orange line, which shows the payoff of this option at expiration. If the stock price is at or below $100, then the loss on the trade is the premium paid, or the $5. Above $100, the value of the option increases in line with that of the stock. Notice the break-even for the long call position is $105, which is simply the strike price plus the premium paid. Right now, the option has 60 days until expiration. Now let's jump forward in time 10 days. Since we've bought the 100 strike call, the stock has now rallied $10 and ABC is trading at $110 per share. The 110 strike call option, which now has 50 days to expiration, note both these options have the same expiration date, is currently trading for $5 per option. If we sell this call option, our net position is now long a 100-110 call debit spread. We own the 100 call and we have sold the 110 call against it. However, because of the move higher in the stock price and the associated increase in the call premiums, the spread is established for zero cost. The amount we paid for the 100 call is totally offset by the sale of the 110 strike call. So, how does this affect our payoff diagram? Looking again at the orange line, there's a few key points to note. Firstly, the strategy is risk-free. The maximum loss on any call debit spread occurs below the long strike and is equal to the premium paid for the spread. Since we manufactured a zero-cost structure, there is now no risk associated with the trade. Note that the sale of the 110 call caps the maximum profit on this trade. The maximum profit occurs above this 110 strike. A debit spread maximum profit is of course equal to the width of the strikes, in this case $10, less any debit paid for the spread. Again, since the spread has zero cost, that max profit is $10. It should be noted that if you can actually sell the 110 call for more than you pay for the 100 call, the spread would actually have been established for a credit, and therefore the maximum profit would be the width of the strikes, 110 minus 100, plus that credit received. That's all very well, of course, but the trade doesn't come without risk. Clearly, in order to have the opportunity to leg into the spread and create the risk-free trade in the first place, you need the stock to move relatively quickly in the direction you're expecting. This means that there is still plenty of premium available in the higher strike call options, and so the stock need not move as far. Had ABC taken 50 rather than 10 days to move higher, for example, time value would have depleted much of the remaining premiums available in the upside calls. So, your initial risk and maximum potential loss on the trade is the premium you pay for the long leg. This is the same as any long option play. If you recall from the first chart, the first leg of the spread is simply a long call option position, and this reflects your potential maximum downside risk. Bearing that in mind then, what is the best setup for this trade? First of all, in any options trade, my first criteria is always one of liquidity. I like to see very good volume and open interest in the stock's option chains and very tight bid-ask spread. Options trading is difficult enough without paying market makers for the privilege to participate in markets. My advice is to only stick to the most liquid counters. It's important that since you are opening the trade with a long option purchase, that the options on the underlying stock are relatively cheap. Implied volatility on the options you're trying to purchase should be at the lower end of their implied volatility rank or implied volatility percentile. All this means in layman's terms is that if a stock has option chains with a 1-year range of implied volatility roughly between, say, 20 and 100%, it's important that the current level of volatility on the options be closer to the lower end of that range. Something below 35%, for example, would be a level to consider purchasing options. If implied volatility is closer to the upper end of the range, around 85 to 100%, this might be a purchase to avoid, since any decline in implied volatility will seriously hinder the effectiveness of the trade. And given the mean reverting nature of implied volatility, this is much more likely from elevated levels. For those of you familiar with the concept of IV rank, I like to see this measure below 20% and preferably even 15% if possible. In terms of strike and expiration selection, I'd recommend giving the trade plenty of time to move. By selecting options with 60 to 90 days to expiration, you give yourselves a lot of time. While it's tempting to look at very short-dated options, this requires much more accurate market timing, and while premiums are cheaper, this strategy has a much lower probability of success. I like to initiate the trade using an at-the-money or even slightly in-the-money option. Again, while more expensive, this does reduce the extrinsic value component of the long option and gives the trade a greater chance of success in the face of long feeder or time decay. In terms of timing the sale of the second call option, this is more of an art. Obviously, the higher the call you're able to sell, the more profitable the trade can potentially become. But there's a fine line between waiting for the best strike to sell and missing the trade entirely if the stock price reverses sharply. There's no real right or wrong answer here, in my opinion, but a reasonably effective method I've found is using some sort of overbought, oversold indicator, like RSI for example, and selling the upper strike call when the oscillator crosses above 70, indicating the stock is overbought. Obviously though, this isn't perfect since RSI can remain overbought or oversold for prolonged periods of time, but it creates a process and forces discipline in executing the second short leg. Let me know in the comments below if you have any other methods you might suggest for when to pull the trigger on the second leg. In terms of unwinding the package, I like to close all my trades at least a week prior to expiration. This typically avoids any issues with the potential for assignment of the short call option should the price of the stock be trading above the upper strike of the spread. Assignment, however, should not be a major concern though, since of course we own the lower strike call and so the position is effectively covered. If you made it this far, you made it to the end, and your support is very, very much appreciated. If you want to engage with me on a daily basis and talk options, the best way to do that is through my Facebook group, and I've included a link in the description below. Again, if you enjoyed the content, hit the like button and subscribe to the channel down here. I've also included links to additional videos on this channel somewhere over there. Thank you, and I'll catch you on the next one. Cheers.